Viewers, if you like my videos, then please subscribe the channel and click on the bell icon.
Hello viewers, hope you are doing well. In this video, I am going to discuss about mutual funds and investment product. Mutual funds are the collective investment schemes managed by asset management companies which specializes in investing pool of money collected from investors in securities such as equity, debt, money market instruments and similar assets. Let's talk about the mutual funds cycle. Investors pool their money with fund managers who are the employees of asset management companies, and they are responsible to invest the pooled money in the securities. After investing, what returns they are getting or they are generating then passed to the investors. This is how mutual fund works. Now let's talk about the kinds of mutual funds. The first kind is open-end funds, which continually create new units or redeem issued units on demand. They are also called unit trust. The unit holders buy the units of the fund or may redeem them on a continuous basis at the prevailing net asset value, which is also called as NAV. These units can be purchased and redeemed through management company which announces offer and redemption prices daily. The second kind of mutual funds is closed-end funds. These funds had fixed numbers of shares like a public company issued with a specified time, could be bought and sold at the market rates in secondary market. The market rate was announced daily by the stock exchange. After specified time, wound up or converted into open-end funds on shareholders' decision by voting. Currently in Pakistan, closed-end funds are not operational. Now, let's talk about the categories of open-end schemes. Money market, income schemes, equity schemes, capital protected schemes, fund of funds schemes, aggressive fixed income schemes, balance schemes, asset allocation schemes, index tracker schemes, and commodities. Now, let's discuss on it one by one. Money market funds are among the safest and most stable of all the different types of mutual funds. These funds invest in short-term debt instruments such as treasury bills and bank deposits. Income schemes. These funds focus on providing investors with a steady stream of fixed income. They invest in short-term and long-term debt instruments like TFCs, government securities like treasury bills, BIBs, or preference shares. An equity scheme or equity fund is a fund that invests in equities more commonly known as stocks. The objective of an equity fund is long-term growth through capital appreciation, although dividends and capital gain realized are also sources of revenue. Capital protected scheme. In this type of a scheme, the payment of original investment is guaranteed with any further capital gain which may accrue at the end of the contractual term of the fund. Such funds are for a specified period. Fund of funds are those funds which invest in other mutual funds. These funds operate a diverse portfolio of equity, balance, fixed income, and money market funds, both open and closed-ended funds. Aggressive fixed income scheme. The aim of aggressive income fund is to generate a high return by investing in fixed income securities while taking exposure in medium to lower quality of assets also. Balanced funds. These funds provide investors with a single mutual fund that invests in both stocks and debt instruments, and with this diversification aimed at providing investors a balance of growth through investment in stocks and of income from investments in debt instruments. Asset allocation schemes. These funds may invest its assets in any type of securities at any time in order to diversify its assets across multiple types of securities and investment styles available in the market. Index tracker funds. Index funds invest in securities to mirror a market index such as the KSE 100 index, an index of Pakistan Stock Exchange. An index fund buys and sells securities in a manner that mirrors the composition of the selected index. The fund's performance tracks the underlying index performance. Commodities. These schemes enable small investors to take advantage of gains in commodities such as gold through pooled investments. They invest at least 70% of their assets in commodity futures contracts, which include both cash settled and deliverable contracts. These are the categories of open end schemes currently being managed and operated in Pakistan. Now, let's talk about the launching of mutual fund. Pre-IPO process, which completes the seed capital requirement for the formation of fund. IPO, initial public offering phase, which means now the asset management company is launching the fund for the investments of public. Trading. Any investor can trade directly with asset management company, which means the person is not required to find buyer or seller to buy and sell his units. It is open for investment any business day and time, and it is open for redemption in any business day and time. Now, let's talk about the earnings in mutual funds. Being an investor can get his earnings through capital gain, which means the advantage of price appreciation, and dividend, which means if the investor holds the units of mutual fund, then he will get an yearly dividend in shape of bonus units or cash. Now, what are the advantages to invest in mutual funds? Accessibility. Mutual fund units are easy to buy or easy to redeem. Means investor can conveniently buy the units of any mutual fund, or can redeem the units of mutual fund at any business day and time. Liquidity. Conversion of units into cash on any working day. Investors do not have to find a buyer. The fund buys back, redeems the units. Diversification. Pool of investment with diversified holdings. Diversified portfolio reduces investors' risk. Professional management evaluates all the opportunities that arises in the market. Decision of investment after careful examination. Professional management means fund managers. And the disadvantage is all investments are subject to market risk. Every person, every investor, every mutual fund units holders bear risk according to their risk appetite. If the person or investor want to invest in the mutual funds which purely invest in equity market, then risk involved in the equity market will be the risk of equity funds, will also be the risk of equity funds. Similarly, if the investor does not want to take any risk, then he will opt the funds which are investing in short-term and long-term securities and gaining fixed returns. So viewers, this is all for this video regarding mutual funds. Thanks for watching.